So, guys, we're very privileged tonight to have Roland come and talk to us about raising capital for real estate investments. And we're getting a little late here, so I'm going to go ahead and let him take it away. He's going to talk to you guys about how to raise capital and do it the right way, and some of the mistakes that he's seen other investors make as they've tried to raise capital maybe the wrong way. So, everyone, please welcome Mr. Roland Anders. Thank you.
I really enjoyed speaking with this group because a couple different reasons. I really appreciate Phil and Chanel. I think that they give very valuable information, and what they're creating here is a network of people that are all really focused on trying to build wealth through real estate, investing in real estate, and just talking to some of the other people here. What you'll have is opportunities to get to know people that are going to help you finance what it is that you want to do. And I'm a real estate investor myself. I don't believe in investing in the stock market. I think it's a casino, honestly. And, you know, casino is gambling, and it's built to where the house always wins. So maybe you're successful, maybe not. But what I like about real estate is, you know, I'm sure I'm preaching to the choir here. It's something you control yourself. And you can touch it, you can feel it, it's right there. You're not relying on some public company to make all these disclosures to you and tell you the truth about what it is that they're really doing. Maybe they're telling you the truth, maybe not. But with real estate, at least, it's all on you. You know, you can make that evaluation yourself. So I like this group. I think there's a great energy here, and it's, you know, really attributable to Phil and Chanel and the team that they've created. And so I grew up here in Austin. I've lived here all my life. I'm 45 now. I went to high school in McAllen. I went to UT undergrad. I couldn't get into UT law school, so I went to SMU in Dallas. Came back here as soon as I could afterwards, and have been here ever since. I've got 4 kids, and both sets of parents live here, so I've got definitely long-term ties to the Austin community. And, you know, Austin's a great place, but for me, it's home, and I'll be here for a little while. But I'm a corporate attorney first, and what that means is if you need to form an LLC, if you need to form a corporation, partnership, you can come to me and I can help you do that. And it's really a pretty easy process. There's a document that you file with the Secretary of State of Texas. You can do it yourself. And for my friends, for people that, you know, I meet here even, I mean, I would help you to do that for yourself, really. If you could, I would figure that out. But what I also am is a securities lawyer. And securities, you know, that's what this presentation is all about. And going into this, I want to tell you, this is a long presentation. The first time I did it, I joked with Chanel afterwards that it was kind of like a law school lecture. I felt like it was just way too dense. And what I really want to do is make this relevant for you. And I understand what it is that you're doing, what you all are interested in doing and developing it. But that's some biographical information. But it's a long presentation. And what I'll tell you is if you miss a slide, you're taking pictures or whatever, please email me, and I'll be happy to send it to you. You know, no worries, free of charge. I mean, it's just an outline of really a summary of the law, securities law, and like the title of the presentation says, mistakes that people make, and really just things that you have to watch out for. But please feel free to reach out to me. I'll email you a copy of this. We can talk about it. That's some biographical information. And again, I try to make this relevant to you all. Who are you? And I think I know most of you. I'm going to skip through some of this, but this is important to bring up. Is what is a security? Most people think about securities. A share of stock. I'm going to go buy a share of Microsoft, Apple, Exxon. That's definitely a security. But a security also can be an interest in a limited liability company or a partnership interest. And important too is debt can be a security. And we had a really good question earlier in the other group. You know, I know the strategies that you're talking about here primarily are going to use debt. And so I'm going to go out and borrow money from a hard money lender and issue a debt instrument to them, sign a note. And with the debt being a security, if I'm doing that individually, it's not a security really. If I'm doing it through my company, if my company is the one that's signing that loan document, then it is a security. But really, because it's a fixed amount that has a maturity date and you know whether it's going to be paid or not, I think about it differently from a partnership interest or a share of stock. And the reason why is because when you buy the equity security, all your money's at risk, and potentially the people that you invest with could lose all of that, and you'd be upset, but in the end they may not be legally liable for you. They could be subject to a fraud. They did everything they could, but because of that fraud, they lost the money. That's equity, so that's a share of stock, one of the liability company interests. The debt, regardless of what happened, you've got this, again, a fixed maturity date, and when the person doesn't pay on that note, you sue them, you take them to court. Really, the only question is, did they pay or not? It's not, you don't go into a discussion of whether the management discharged their fiduciary obligations to the company. It's just really, was the amount paid or not? And so that's an important distinction to make. So a lot of what you're doing now isn't really going to implicate the area of law that I practice in. It's not going to implicate the securities laws. But I will tell you that my very best client last year was somebody that would describe themselves to be just like you a few years ago. And it's two guys, they partnered up and they started doing fix and flips, and I think they were doing some wholesales as well, and just continued on having success, implementing their strategy, being really systematic about it. One guy's an engineer, that engineering background, really the detail-oriented nature of it. They're doing a great job. And last year, what they did is they ran across a little project in East Austin. It was a little mini neighborhood of 6 old homes that they're going to buy and rehab and then sell. But it was a big project, and they needed to raise $600,000. And so instead of going to the hard money lender, they were kind of tapped out at that point. They needed to go raise equity. And so they formed an LLC, and they hired me to help them to sell the LLC interests. And that was a representation where it was completely appropriate to use my services and necessary to engage somebody like me, because you have to document these arrangements, the financing arrangements, and we'll get into that documentation a little bit. But I guess my point is I look at a group like this, and I know, like us, the securities laws are very complicated, and when you start thinking about them, you can kind of go off into things that are really probably not too relevant for this group. But I do look at you all, and I know that there are going to be people out of this group that are really successful. They're going to go on and do bigger and bigger deals, and eventually you're going to come back to me and call me in a couple years and say, "Hey, Roland, I heard you speak a couple years ago. We're going to buy a 100-unit apartment complex, and we're going to raise $5 million. And we want you to help us do the raise for that. Form the LLC, draft the disclosure document." And so I know that in the future I'll be talking to some of you, and I can't wait. So another important distinction is, with the securities that we're talking about, securities of a company like Apple, Exxon, they're public securities. And what those companies did, they went through this process called registration. They registered their securities with the SEC. You go through this process where you file this long document with the SEC, and they approve it. And then after that, you can sell your shares of stock in the public markets, like NASDAQ and NYSE. And I was talking with Jody before about pink sheets. That's another place where public companies trade their stock. But only a very small fraction of companies in the United States are public companies. I need to look the statistic up, but I think it's less than maybe like 1%. So what I'm dealing with are the instances where we're not going to go and register your securities with the SEC, but there's an exemption from those registration rules. And you may have heard of it before. There's several, but Regulation B, if you've heard of that, that's Rule 506. That's an exemption from the securities laws. And it basically just means that instead of publicly advertising your securities, or instead of being publicly traded, these securities are sold in private transactions. And so I can't use any advertising. In the past, it's been true, but it's not actually now. But in the past, you haven't been able to use any advertising, and advertising would include putting something on your website or taking an ad out in the newspaper. And so these private transactions, I can only sell securities, I can only take your investment dollars if we've had some kind of pre-existing relationship. Maybe we met here, and I found out that you've got some money that you want to invest, and so I meet you here, and we're talking about, I've got this project, I wait 30 days, and after that time period, that's really significant, by the way. I can ask you, hey, would you like to invest with me? And at that point, that solicitation is not considered advertising, or the term is general solicitation. So I couldn't stand up here in front of you tonight, and I can now, actually. In the past, I haven't been able to, but I couldn't stand up here and say, hey, I've got this great software company, and we're going to go out there and kill it. We're going to, we need $1 million right now to write this piece of software, but I guarantee in 5 years you're going to get all that money back times whatever. I can't do that because that's a general solicitation. It's a public meeting. In the eyes of the SEC, it's just like if I took an ad out in the newspaper or put it up on a billboard. But I tell people now that it's an exciting time to be a securities lawyer because there's some changes in the securities laws that now, in fact, allow for advertising in connection with the sale of private securities. And that's really significant because now what I can do is I can put it up on my website and say, hey, you do have an investment opportunity, and I'm using advertising. But I'll get into that in just a second. But again, that's still, even with the advertising in that instance, it's still private because I'm not having to go through that whole registration process.
I hate to interrupt you. I just have a quick announcement. If there's anyone still interested in getting registered for the big live event, we will see you out in the hallway. Also, if you have one of our buzzers, if you could please return those to us out there. Thank you.
And so, what I tell people is the time that you need to come talk with me is when you have a partnership, an LLC or a corporation, and you have two scenarios. One is where you have a diverse ownership group, where you have more than one owner that maybe it's not a husband and wife, it's just two people that maybe they're friends, or maybe it's three people and two of them know each other and one of them has a friend, he brings them on. But in that instance, when you have that diverse ownership, you have to think about control. Who controls the company? Because control statutorily is defined by percentage ownership. We all kind of have this concept of, well, if I own a majority of the company, I control it. And that's true in one sense, but there are some transactions where 2/3 is really important statutorily, 2/3 ownership test. But all of that really can be varied by agreement. And so that's really when you want to come talk to me, is you have three people getting together and one person's going to have 20%, one person's going to have 30%, and now we've got 50 left over. Or let's mix it up a little bit. We really have to understand who controls that. Which two people are going to be able to ultimately make a decision about the management of that business independently of the others. If there's some kind of disagreement, if everybody agrees, you don't have to worry about it. But that's one instance where you get me involved. The other instance is, like my friends, these two guys are partners in a real estate development company, and they have this project, and they went out, and they said, hey, we've got this great idea. We need money. We can't use debt anymore because we're kind of tapped out there, and the returns that we project on this are really more appropriate for an equity investor. And that's one thing you want to think about, using equity versus debt, because debt, the return is capped at the usury rate, which in Texas is about 18%. But equity, it's limitless. And the return is limitless, but also your potential for loss. You could lose it all. And like I said, it's possible that I may not be legally liable for that amount, for losing your money. So in this instance with my friend, one of the guys, they've got a contractor and his dad wanted to invest, and some other third parties, friends of theirs, but not people that are going to be intimately involved in the project. They're not going to be the ones that are out there hiring the architect, the general contractor, doing the demo. They're really just passive investors. And in that instance, what you've got is a scenario that, and this isn't original to me, but I think it's really, I think it's kind of humorous, but you're using other people's money. And it's an acronym, OPM. And I think about, what does that sound like? OPM. And you take that money and you forget that it's not your own money. And so you take it in, you go out and spend it, and do whatever you want with it, but you forget that you've got an obligation to your investors. And so that's really what I like to talk about, is that obligation, that ongoing obligation to your investors. And when you go out and you tell people, hey, I've got this great investment idea, what I advise you to do is, in that instance where you have these passive investors, you want to prepare a document called a private placement memorandum. And what this is a summary of the project. I'm going to tell you what it is that I'm doing, why I want your money, what I'm going to be doing with what I'm going to be doing with your money. Here's the budget. Here's a summary of the project. I'm going to give you biographical information about me and all the other people that are involved in management. I'm going to disclose risks to you. I'm going to give you a summary of returns. You're investing $1 million with me, so I promise I'm going to give you 9%. Then when we sell the project, 9% preferred return every year. But when we sell the project, all the cash is going to go back to you. Once you get your investment dollars back plus the 9%, we're going to split it 50-50. That's pretty fair. Depending on the deal. I mean, the terms vary, but you're going to provide a summary of what those terms are in this document called a private placement memorandum or disclosure document. And it's really just telling the story about the investment opportunity. And what you want to guard against is the situation where, when I give this talk, I have to kind of be the bearer of bad news, because really what you're guarding against is a situation where you've gone out and you've raised money from people, and notwithstanding your best efforts, you did exactly the job that you were supposed to do. But we all know that sometimes, even the best, our best efforts, things fail. We fail, a business will fail. In that circumstance, like I said, the investment dollars the loss is unlimited. So you could be in a situation where you've lost all your investors' money. And what you want to prevent, what you've hired me to do, is to keep them from saying later on at that point, hey, I didn't know that you were going to invest in whatever. If this is my friends, this little mini neighborhood that they were investing in, they take the money in from their investors. I know they're going to be successful, so this isn't going to happen. But, let's take the hypothetical. They lose all the money, and now their investors are saying, what the hell, you lost all my money. And then they're coming back and saying, hey, I thought you were going to invest my money in a McDonald's franchise. I didn't know you were going to buy this little mini neighborhood and do all this work. And what my friends can do now, for what I did for them, is I drafted a disclosure document for them. And it says on page 2 exactly what they're going to do with the money. And so they can go back to the investor and say, sorry, I don't know where you got that idea, but we said that we were going to invest in this little mini neighborhood. And, I'm sorry, but, that's... So the disclosure document, and this term disclosure is just telling people what it is that you're going to do with their money. And then you also have this ongoing obligation to tell people how the project's going. Quarterly, at least, have a call with your investors. Annually, you deliver financial statements. Every year, if you have an entity where you sold partnership interest or LLC interest, if it's taxed as a partnership, you're going to prepare a return for the partnership, of course, but you also have to deliver Schedule K-1. So you've got these ongoing financial reporting obligations to your investors. But anyway, I'm getting a little ahead of myself, but that's really, this is, I developed this presentation a couple of years ago, and I've updated it since, and I probably need to again a little bit. 6 months or September, maybe a little longer than that. But when I was thinking about this initially, this is really, in my mind, the most important concept that, I know for many of you, this is something that's out in your future. But, when you take in those investment dollars, just never forget it's other people's money, and they're going to want an accounting for it, one way or another. So I'll just start going into some of the mistakes that I've seen, and really these are just considerations, but we talked about this a little bit before. This is an important consideration. In Texas in the past, there used to be a reason for using limited partnerships. You may have heard about this. There was an exemption from the Texas state level entity income tax. So the income tax that Texas imposes on business entities like corporations, LLCs, it used to not apply to limited partnerships, but that exemption's been done away with. So really what I counsel most of my clients to do now is form an LLC. There are still good reasons for using corporations, and with an LLC, you always have the ability to make an S-Corp election as well. So they're real flexible from that perspective. But this is a consideration. State of incorporation, you'll hear people say, well, I want to form a Delaware entity or Nevada entity, and I think most people do that because they think that they're going to save on those franchise taxes in Texas. And there are exemptions from the franchise tax rules, so you can make up to, I think it's like $650,000. It's a large amount. So if you're having problems with franchise taxes, that's a good problem to have in my mind. But really, what the state tax regime is versus the federal is that it's all source-based. So even if I have a Nevada corporation that owns a property here in Austin, because the property and where all the money is being generated is here in Austin, I've got a filing obligation to the Texas controller. And people will gain that, and they'll say, well, no, I'm a Nevada corporation, so I don't have to do that. Well, technically, the rule is that they have to report their Texas source income to the Texas Taxing Authority, which is the controller. So, there are reasons to use Delaware and Nevada entities, but it's pretty rare, honestly. Failure to qualify investors. So one really important concept in the securities laws, and this is another important concept that you can take away with you tonight, is, they were enacted, the main federal statute that I work with all the time is the Securities Act of 1933, and there's another statute that's comes into play whether we know it or not. When you hear about broker-dealers and public companies, it's the Exchange Act of 1934, and those dates are really important because they were enacted right after the Great Depression, where there was this time period, I think there was public sentiment where, there was all this fraud, and we've got to protect the little guy from, people out there in the marketplace promising them all these get-rich-quick schemes, fleecing people of their money, and protect the widows and orphans, protect them against, unscrupulous fraudsters. And so, what these rules that I work with all the time really make a distinction between non-accredited, and I'm going to use a term, non-accredited investors and accredited investors. You may have heard that term before, but an accredited investor, just think of them as a wealthy investor. I think probably have, yeah. And this is a definition, but basically it's anybody with $1 million net worth or who makes $200,000 in income every year, $300,000 together with their spouse. And the philosophy in the SEC's mind is that these people have the financial resources to go out and hire financial analysts and accountants, attorneys, to help them evaluate whether this investment that they're going to make is a valid investment. And again, we're talking about investments in private securities where you don't have all this disclosure that's publicly available like you do with Apple or Exxon. You can't go to a website and look up my company and say, oh, well, that's their last quarterly report and their annual report. You're really relying on me to provide you with that information. I have an obligation to do that. But again, in SEC's mind, a wealthy investor is more equipped to figure out whether this is a good investment. And then when things go sideways, when things go bad, that person's going to have the resources to hire an attorney and go enforce the company's obligations. So they're going to be able to sue the person for securities fraud. This is a really important distinction, and what I'll tell you is you only want to sell securities to private securities to accredited investors because it's a lot easier, and when you have that lawsuit scenario, it's going to be more difficult for them to say, hey, I didn't know what was going on. They have a pretty significant net worth or income, so they're really charged with hey, you should have known better, or you have the resources to protect yourself in that scenario. The court construes that a loss to an accredited investor differently from a loss of a non-accredited investor. And this comes into play with respect to some of the specific exemptions that I mentioned before. And again, the bottom line is, when you're selling your securities, your stock in your company, solely to accredited investors, it makes things a lot easier. There's still ways of doing it. Here in Texas, there's an exemption where you really don't have to do anything except qualify your investors as being sophisticated. We maybe talked about, I don't know if I've got a definition of that here, but I mentioned it there. There's a way to do it, but that's really for smaller offerings, and you're limited to 35 investors, and they all have to be here in Texas. So this is another important consideration. If you've ever heard the term blue sky law, what that is state securities law versus federal. And there's a federal statute that I mentioned before, but each state has its own securities laws, and they vary from state to state. When you're dealing with all accredited investors, they're really uniform across the states, but when you have non-accredited investors, you have to work with different exemptions, and each state has its own exemptions there that you have to consider, and it's the state law of the state where your investor resides. So if I get an investor from Oklahoma, I just look at their address, and I say, oh, I've got to comply with the Oklahoma securities laws. Again, this is, it's kind of obvious that, and you're going to have a hard time getting anybody to invest with you. They may, but again, disclosure. You're going to prepare documents to them that are going to tell them what it is that you're doing. And it's that advanced disclosure of the risk, the opportunity, but also the risks. And this is the standard, the underlying language here is really important, getting this notion about this is a standard in the federal law, and it's applicable in the states as well, is you can't fail. Like when I'm selling, hey, I've got this great investment opportunity, come invest with me, come be my partner, my equity partner, not my debt partner. Excuse me. I've got to tell you all the material information that you need to know to make your investment decision. And I also can't fail to tell you anything where the failure to tell you is material. So I can't just omit that there's an Indian burial ground on the property, that I know is going to make it impossible to do what we're intending to do. Or I can't omit to tell you that there's radioactive waste there. It's a great deal except for that, and we're just going to leave that aside. Sorry. Again, just scrolling through these inadequate definition of investment terms, you want to hire somebody like me to thank you so much. You want to hire somebody like me to make sure that your partnership agreement defines the terms of the deal and defines everybody's expectations and does it clearly and doesn't leave anything out. It's really obvious that you can form a LLC with LegalZoom, and there are tons of forms, partnership agreements, company agreements you can get off the internet now, but you never know whether those agreements, unless I've had some clients that do draft their own documents, and they're super smart, but it's really rare. Just anything that you can get off of the internet, just make sure that it's applicable to the deal that you're working on. This is kind of goes without saying. I'm trying to include everything in here, but taking money in. If you're in a situation where you've got this investment deal and you're going to form the LLC and you're going to go out and raise money and somebody says, well, here, I'll give you money today before you even have the documents on. I say, don't take that money because you want to have it all wrapped up and defined and documented before before you actually accept money from your investors. Again, this investor reporting, monthly, quarterly letters, accounting, we mentioned that before, tax reporting. This is an important concept. There are two things here, really. One that maybe I don't have up here now, but one of the reasons why you form business entities is to protect yourself from personal liability for any liabilities of the business. So I've got my yogurt shop, and I own the yogurt shop through my LLC, and when a customer comes in, they slip on water that's spilled, they sue me for that. They can when they win that lawsuit, I owe them all of a sudden $100,000. They can do anything with the business. They can take all the inventory or the machines or whatever it is that I've got there, but they can't come after me personally. So I own 3 other businesses, all these other assets. They can't go after those unless I've committed fraud or certain circumstances. Piercing the corporate veil is a term you may have heard. But with securities laws, what you're doing is you're going out and you're saying, hey, I've got this great investment opportunity, trust me. And that notion of trust, that confidence that I'm asking you to place in me, really changes the whole schema and how the law thinks about what I'm doing. And in fact, in that instance, I can't hide behind my entity because I've made a personal representation to you. And so when you come back and sue me for securities fraud, when you tell me, hey, I didn't know that you were going to invest in that apartment complex. I thought you were going to invest in McDonald's. If you win that lawsuit, potentially I have personal liability for that. I'm not shielded by my LLC. And that's a really important thing to remember. And it's important too because what the remedy is, if you win your lawsuit against me, the remedy may be that I have to make it as if you've never made that investment. So that means giving you your investment dollars back, and then also a return. It's at a statutory rate of interest. It's pretty low, but it's like I have to make you whole, and it's going to come out of this wallet, not the company's wallet. This is again, I tell people it's an exciting time to be a securities lawyer because there's been some changes recently that for the first time allow the use of general solicitation in connection with the sale of private securities. And what that means is I can take out an ad in the newspaper now and advertise the fact that, hey, I've got this great investment opportunity for you. I've got to be careful about what I say, and it's got to appear professional, but I can do that in a way now that I've never been able to in the past. The rule with that, though, is there are 2 exemptions now that allow for advertising. One is where you only can accept investments from accredited investors if you verify their status as being accredited, and that means you have to, in the past, you've just been able to rely on their self-certification, but now you have to get a copy of their W-2 to verify their status as being accredited. There's another exemption that in fact, went into effect this past Monday, and it allows for the sale of private securities to non-accredited investors as well. And that's going to be something I think we'll see more and more. It's going to be a really great tool for capital formation for smaller deals. Finder, I mentioned this. I think about this. I've got this buddy of mine. He's got a great idea. He's identified this great investment opportunity. And then I also know all these wealthy investors over here. Why don't I introduce them to my guy? He's looking for investors. They're going to come in and invest $1 million with him. And hey, in exchange for that introduction, you're going to pay me 2% of that. So I'm going to get $20,000. That's fair, isn't it? In fact, it's illegal. And if I'm not a registered broker-dealer or something called a finder, I really can't accept that money. I can't accept that $20,000 payment for making that introduction. And one thing I'll tell you, I'm telling you what the rule is, but in practice, it happens all the time. These payments get made, and there are ways of structuring it, where you can sort of make it like a consulting fee that's paid out over time. But But what it is transaction-based compensation, and the rule is really that you need to be a broker-dealer. There's something called a finder in Texas, and I can tell you about that as well, but the bottom line there, use of finders can be problematic. So this is, again, coming back to this, I've enjoyed getting to know so many different people, and this is the third time over the past couple weeks I gave this presentation. I went up to the RIA meeting in Dallas and also in Houston. I really have enjoyed getting to know people here in Dallas and Houston. I invite you, please call me anytime with any questions. I'd be more than happy to talk with you. That's my contact information. And again, I want to make this relevant to you, so at this point, I know we maybe have limited time, but if you have any questions, I'd be more than happy to